Ladies and gentlemen, it's my pleasure to welcome you all back to our quarterly investment and market update as we review the first quarter of 2024. And we're here thanks to virtual financial advice, making financial advice affordable for all Australians. My name is Paul Jantz. I'll be your host, and it's great to have you guys back again for another investment and quarterly market update. Now, let me welcome Virtual Financial's CEO, Adem. How are you? Welcome back.
Good, mate. Thanks, mate. Yep. Going well.
It's good to have you back for another quarterly investment update, mate.
Yeah, it's great. It's great to inform our clients and keep them up to date with what's going on. And we've got some great guests today. Obviously David from Betashares and Rob, Coyte from Shartru, who's the CEO there. So, and on the investment committee. So, yeah, look, it's great. Yeah.
Beautiful. Let me introduce those guys formally. I've got Rob Coyte, CEO from Shartru Wealth. Welcome, Rob.
Thanks, Paul. Good to be here.
Always good to have you back, mate. And David Bassanese, good to have you from Betashares Capital.
Great to be with you all.
Beautiful. Now, Adem, I might let you kick off and let you share a little bit about your relationship with both Beta Capital Shares and Shartru, because I think it's important that our clients understand exactly where these guys fit in, and also share that this is general advice only.
Yeah, exactly. Yeah, so it's general advice today. We're not taking into account objectives, financial situations or needs. So, obviously, if you want advice in regards to any of this, please make an appointment to see myself or one of the advisors. As most of our clients know, our dealer groups, Shartru, Rob Coyte's the CEO, he's on the investment committee, really helps us with putting together our MDAs and the portfolio and how it matches with different investments. One of those investments that we have in our portfolios, obviously, is Betashares, and we use that for different funds, sometimes the Australian share fund, sometimes fixed interest and whatever. And then obviously with Betashares, with David, great to have him along. Want to keep our clients informed. And, as I said, we use a lot of Betashares for our retail clients that might not have a self-managed super fund, but they might have, 100 or 200,000 in super. So a great option for our clients is to use Betashares, and, they've performed really well. They're a great investment for our clients. They're very well priced, and we've been using them for our clients.
Brilliant. That's a great little summary. So it's great to have everyone here. So let's get into today. Rob, let's talk market update. As you've been sharing with all of the clients at Virtual Financial Advice for probably more than 2 years now with these updates. Mate, what can you tell us on the share front of the last quarter? What can you share?
Yeah, well, last quarter was, again, a pretty positive quarter. Aussie shares were sort of up around about 5.3%. Smaller companies also sort of made a bit of a run. They were up around 7% for the quarter, which is good to see. International shares continued to surge ahead, with unhedged shares going up 13.2% for the quarter. And property had a big run over the quarter, going up, making the second big quarter in a row, going up over 16%. So that was good to see as well. On the flip side, we also had interest rates going up as well, and that's actually exacerbated after the end of the quarter, and interest rates are considerably higher now than what they were then. So that was interesting. And as an old gold bug, gold's taking off. So that's all these numbers are giving us interesting messages, and I'm sure that there's more than a few people in the market that are contemplating what these messages are, because it's quite confusing at the moment.
Very, very true, and I think that's it's an interesting one with the gold. So your thought process is continue to look on the old gold.
Yeah, yeah. I don't understand how Bitcoin works. So I'll leave the Bitcoin investment / speculation to others, and I'll stick to the gold.
I agree with you. I agree. I don't think most of us on this panel may not actually understand how it works at all.
No idea. I've got no idea.
Maybe you're the wrong demographic.
Yeah, maybe.
Adem, is there anything you'd like to add with what Rob just covered off then?
Well, certainly, I've got no idea about Bitcoin or all that. Clients ask me all the time, to be honest, in regards to that sort of, and I just say that I don't understand it, and Bitcoin doesn't pay an income ongoing, so you don't get dividends or an income source. It's purely a capital play, and unless it goes up, there's no money to be made. So I'm a bit like Rob. I'd rather stick to gold and shares.
Yeah, well said. And I think the last update we did as well, you spoke about copper. So copper being one of those ones to watch, let's call it. And now we're talking about gold. And I suppose the copper and gold doesn't tend to go away, does it?
Yeah, well, copper actually has had some big moves over the last few months as well. So, interesting.
Yeah, very interesting. And that was, again, if anyone missed our last update, which was our February for the last quarter of 2023, it's exactly what Rob mentioned there. So it's good to hear you step into that one as well. David, we might go to you, mate. So what's been some of the main drivers of the markets for you this year? And what do you expect will be drivers for them for the rest of the year?
Yeah, well, I mean, I think there's like two main things that have been driving markets this quarter. Firstly, the US economy. I mean, the story there is, the Fed late last year pivoted. They suggested we're done in raising rates. The next move is down. Markets got very excited. We started the year with 6 rate cuts in the US priced in to the market. Bond yields had rallied quite a bit up until Christmas. And really, the quarter was one of pricing out those rate cuts. And now we're back to like 1, maybe 2 rate cuts priced in because the US economy has been pretty resilient. Consumer spending, employment growth still powering ahead. And we've had some upside surprises on inflation, particularly the CPI. And so markets have priced that out. Interestingly enough, up until recently, at least, equity markets have held in pretty well despite the backup of bond yields. So bond yields have gone up, but equities have continued to go up because of the resilience of corporate earnings, resilience of the economy. One thing that supported the equity market was the Fed, the US Federal Reserve, initially was dismissive of the upside surprises in inflation. They were saying, oh, these are speed bumps on the way down. Just recently, as Rob mentioned, there's been a bit of the interest rate effect has started to, impact on markets because the Fed have changed their mind. The Fed, Powell only recently, the Fed chair said, maybe inflation's, it's not giving, I think the words were something like, we're not getting more confidence that inflation is coming down as we expect. And basically confirming that they may not cut rates as aggressively as the markets were hoping. And so that started to weigh on the markets a little bit. The other big factor, of course, is geopolitical risk. And, I think that's been a major driver of the gold price. I mean, gold's gone up interestingly this quarter, even though bond yields have gone up and the US dollars remain strong. So those are two things that usually don't favor gold going up. But it's been obviously the escalation of tensions between Israel and Iran. Well, we're just seeing how that plays out. At the moment, it looks as if both sides want to not escalate things too greatly. But that's been weighing on the equity market as long as supporting things like gold. So in summary, they have been the key things, the zigs and zags of the US economy as normal, and the geopolitical situation in the Middle East in particular.
Yeah, well said. I think the zigs and the zags are always interesting depending on what's going on overseas, isn't it?
Yeah, well, again, like a lot of my focus is on you've got to boil it down to the essential parts. There's a lot of moving parts in the global economy, of course, but ultimately the US is still the major driver of things, and so I focus a lot of my time there. We can talk about Europe and Japan, China. These are kind of interesting, I guess, side stories at the moment, but the main plot in markets is still the course of the US economy. And fingers crossed, things are, still looking good for the US economy. It's quite resilient. The interest rate rises have had hardly any impact on the economy. It's been quite amazing. But inflation has still managed to come down, which is hence why we've gone from, fearing recession a year or so ago to now hoping for a soft landing. In fact, base case expectation is we can get inflation down without a recession, which is why equities have been rallying for the past more or less since late 22.
Brilliant. We'll talk about that in a second. So You mentioned the word risk before. So what's the biggest risk to the markets at the moment this year?
Look, well, the two things I mentioned, I mean, probably the biggest risk is stubborn US inflation. I mean, if that stays where it is, or heaven forbid goes higher, not only will the Fed not cut rates this year, they might actually have to raise rates further. And if bond yields go up, US 10-year bond yields start going up, that's going to weigh on the equity market, because valuations, if you look at things like the equity risk premium of the market, so the market's earnings yield, the value of the share market, less the bond yield, it's at a very tight level now. The markets are, it's almost like the bond yields are going up, and it's like putting straws on the camel's back. And, you know, one more straw and it could just break the camel's back, at least for a while. So that is the biggest risk. Secondary, of course, is just, you know, what goes on in the Middle East, what goes on in Europe with the tensions there.
Yeah, good point. Good point. So what do you think will happen with interest rates here in Australia? So, and how will that potentially affect the equities and even the property market?
Look, we're following the Fed a little bit. I mean, I think the inflation here at the moment hasn't surprised on the upside in a way that it has in the US. It's still broadly coming down. The RBA would be conscious that, you know, upside surprises in the US may be reflected in Australia. So they'd be conscious that that could be a signal that inflation could surprise on the upside here. Bottom line, look, I still think inflation's coming down here in a way that the RBA can cut rates later this year. I used to think they could cut rates twice and maybe as early as August. I now think maybe only once, and probably not before November. So maybe November, December. Which is sort of where I think the markets are. It's almost like markets are just clinging on. They've pushed out the rate cuts right till the end of the year now, and they're still clinging on to 1 or 2 rate cuts by year end, around November, December. And that's still my base case. There's a very, you know, a lot of information to still come out in Australia, the CPI and whatnot. But, you know, I still think inflation's coming down, and central interest rates are restrictive, above average. And so all you need is further confirmation of that disinflationary trend, and the RBA can take its foot off the brake a little bit.
Interesting. So that will that have any impact on our equities and property markets, do you think?
Yeah, I mean, look, it has been. I mean, I think, you know, as mentioned, our market has been in this choppy sideways range for a couple of years. We've had an earnings overhang as commodity prices have come off, but it's actually broken to the upside through the quarter. You know, had a nice upside breakout in our market, and I think markets are starting to think that rates will come down. So it's supportive of things like property. You know, listed properties had a great run on the back of that, but also just the earnings outlook for the broader economy is starting to improve, and the markets are sort of anticipating, you know, a recovery in earnings as we move into late this year, early next year. So yeah, it is starting to have an impact on our market.
Yeah, brilliant. Rob, anything you'd like to add to any of that, mate?
Yeah, look, I think the beauty about markets is it's people have different views which make the market. And I guess our view is probably a fair bit different. I would agree with David in the fact that the US is the main game in town, and that's what's driving everything. But basically, we believe the fiscal position in the US is the thing that's actually keeping that's the thing that sort of people aren't necessarily paying heed to, and that's basically meaning that they're keeping money in the economy, and they're pumping, like they pumped $1 trillion in 100 days. I mean, it's near impossible to have a recession with that sort of money getting pumped in. And on the flip side, what bond investors are saying is, well, if you're going to monetize this debt, we want to be compensated for it. And from the geopolitical side of things, they've weaponized the US dollar, which I think is a huge mistake. So China, Russia, the other types, they're firmly, and they have been doing this for a while, they're looking at how they can de-dollarize. And any move to de-dollarize will mean that there'll be less people willing to hold US debt, which gets back to the old demand supply. If there's not enough demand for what you're supplying, the price has got to go up. So we think inflation is going to be a lot stickier. We think it's going to be a lot higher. We think it's the end of cheap energy. We think it's the end of cheap labor, largely to do with the deglobalization that's going on. and the other one is cheap energy. And the more that we sort of cling to this climate change narrative, I can't see how you can get inflation down to 2% with those key inputs considerably higher. So we're setting ourselves for higher rates for longer. And the reality is that the US is in a situation now where they're either going to have to fight inflation or they're going to have to protect the integrity of the dollar. And history always shows that they will let the dollar suffer. These sorts of things take years to play out. So there's a lot of ups and downs on the in-betweens. But basically, that's the way that we see the world and how we're positioning ourselves at the moment.
Okay. Interesting. Adam, anything you'd like to add to any of that, mate?
Yeah, look, it's all really interesting. I'd probably just like to ask David what his thoughts are with the Australian dollar versus, the American dollar, because it just seems to be going down and down and down, just your thoughts on that, David.
Well, look, at Christmas time, it was at 68 cents and it seemed to be on the way to 70. So it was looking strong. And that, again, I just put it down to the shift in Fed rate cut expectations and the geopolitical issues. So the Aussie dollar's weakened this year because at one point the markets thought the Fed would be cutting rates as early as March, and they thought there were 6 to come. But that's all been priced out. So the interest rate differential moved back in the US dollar favour, and so that strengthened the US dollar. And just the increase again in that geopolitical tensions, US dollar tends to be a safe haven in that regard. I mean, it is still the world's reserve currency. There's, as Rob pointed out, a lot of risks around the US dollar going forward, but at the moment it's the go-to place as a safe haven. So those two things I think have worked against the Aussie this year. But yeah, going forward, I mean, I'm bullish on the Aussie at current levels because ultimately I think we are going to get the Fed rate cuts, and the Fed will be cutting rates more aggressively than we will because they raise rates more aggressively. And the other thing is, as the global recovery broadens out, I'm a little bit more optimistic, I've got to say, maybe at least in the short run than say Rob. As that, risk on sentiment will broaden, Europe will look better, Japan will look better, and the US dollar safe haven stature will weaken, and that will favour the Aussie dollar. So I'm seeing it break above 70, later this year, moving into next year. But yeah, in summary, that's the sort of I think at least why it's done what it's done so far this year.
Thanks, David.
Yeah, good question too, Adam. Now, guys, as we look to wrap this up, our quarterly investment update, guys, any parting comments? Rob, I'll go to you first. Any parting comments?
No, I think from our perspective, I think, as I said, there's a lot of mixed messages out there. There's a lot of what if scenarios. That's how our markets work. Our focus at the moment is making sure that we've got a portfolio of assets. We are focusing on having assets that are lowly correlated to each other. We don't want assets that are going to all perform the same way at the same time. And that's basically how we ride through the ups and downs.
Brilliant. Thanks, Rob. David, any parting comments?
No, just, I mean, again, I think the US inflation numbers over the next couple of months are going to be absolutely critical. I mean, we've had 3 upside surprises. Maybe that's the end of the upward surprises. I don't anticipate a lot more. I'm bullish on inflation coming down. But certainly be watching those numbers very carefully over the next few months.
Very true. And Adam, over to you. Any parting comments?
Yeah, look, just one last question, probably to Dave and Rob, just in regards to the election coming up in the US. A lot of my clients ask me about how's it going to affect the markets. Is now a good time to invest? And, it looks like from what I'm reading that Trump might get in. So being Republicans, is that a good thing for the markets, I suppose?
Look, just quickly from my end, I think markets are now, love or hate Donald Trump, I think Wall Street is sort of comfortable with him. He is a Republican in the sense that he favours low taxation, low regulation. The 2 risk factors for him will be, tensions with China, but that seems to be more of a China concern at the moment. Like if trade tensions with China increase, I think it'll hurt the Chinese market more than it'll hurt the US market. And the other one, as Rob correctly points out, the budget deficit. No one in the US cares about the budget deficit. Certainly Donald Trump doesn't care about it. And one day bond markets may wake up and demand a higher premium. But Donald Trump coming back into the power could be a catalyst for that. So things to watch going forward. But in the main, I think Mark, again, when he won last time, markets turned on a dime and have rallied ever since he got elected. So
I think David hit the nail right on the head. I don't, leading into this election, I think there's probably going to be more impact on society than markets per se. It's going to be a very polarizing election. I think Blind Freddie can see that. From a practical perspective, I'd agree with David. Neither side of politics in the US cares about the deficit spending, and they're not willing to do what's required to fix it. So from our perspective, we don't think it's going to have any say whatsoever in regards to what we see as the key issues over the next few years.
Yeah, well said. I think it's probably more of how our personal opinions will feel about it as opposed to the markets, isn't it, really?
Yeah. Oh, it's going to be a very polarizing election.
Well, at least we sort of know what we're going to get, I suppose, don't we?
Yeah. Well, we're a long way from the action, so that's probably a good spot to be.
Very true as well. Very true. Well, guys, thank you. Thanks for joining us, for all your thoughts, your comments. I think, again, just a really, really clean little market update, investment update. David, thank you for joining us for the first time.
No worries.
So, it's always a
Thanks,
pleasure
David. Cheers,
doing
mate.
some work with Betashares Capital, and obviously Rob, for you joining us again. It's always a pleasure having you on here, and your wisdom and your thoughts that come with that are absolutely outstanding. So thank you again.
Thanks, Rob.
Thanks for having us, guys.
My absolute pleasure. To all of you that are watching this, I hope you've enjoyed our quarterly update, our market update, and look out for the next one that comes out. Please enjoy the rest of your day. On behalf of Virtual Financial Advice, thanks again.